Hey guys, I hope you all are doing well. So today we're going to be looking at India's 40, that is investment property concepts in the shortest possible time. So what are we waiting for? Let's move on to the notes and look to cover this chapter as soon as possible so that you guys are able to revise it in the least possible time in the most efficient manner. So what are you waiting for? Let's move on to our notes and start revising the same. So just a moment guys, I'm just presenting the notes. Just a moment. Yes, guys. I hope the screen is visible. Yes. So if you want these notes, you can join the Telegram channel in the description below or on the bio of my channel. So you can join there and get these notes. So I've covered the channel in almost 2.5 pages. If you just see here, the entire channel. I've also mapped this to every single illustration and question and IC study material. For example, you can just see here. So all the hard work is done. So all that you need to do is just join the Telegram group and get it. So what are you waiting for? So India's 40, investment property. What is investment property? It means land or building or part of both held for rental to others. So rental to others we mean operating lease or sublease of an operating lease. Finance lease is not covered here. So that's something important, guys. Next, capital appreciation. You hold the investment property for the increase in value that is covered here. Then undetermined use. Suppose you buy a property and you don't know what you want to use it for. That is also covered here. Okay. So next, it is not applicable to biological assets related to agricultural activity because biological assets are covered under Ind AS 41 and your barrel plants are specifically covered under Ind AS 16. Your mineral rights and mineral reserves are not covered here. Then your investment property held for sale. Let's say you acquire something as an investment property, you classify it as an investment property in the books of accounts, then you want to sell it, it will come under Ind AS 105 ambit and not Ind AS 40 ambit. Then your impairment of investment property, that will come under Ind AS 36 ambit and not Ind AS 40 ambit. So your recognition criteria, recognition, depreciation, component accounting, everything is a copy paste from Ind AS 16. So you can just go there and refer it. And in case you guys want a separate video on Ind AS 16 as well with notes like this, just comment down below and I will definitely do the same as soon as possible. So yeah. And next is subsequent recognition as at the balance sheet date. So it is same as PP except that there is no concept of revaluation model for investment property. So guys, basically in PP, in subsequent recognition, we were allowed to follow a revaluation model, which is not allowed in investment property. But guys, please note down, you have to give a fair value disclosure in relation to investment property. It is merely a disclosure and not a recognition in the books of accounts. So we will come to that point again towards the end of the chapter. So just keep this in mind. Next, other key pointers. So property acquired with a view to subsequent disposal in near future / or for development and resale. So basically they are referring to the people who are in the real estate industry who basically acquire the property with a view to resale or with a view to develop it further and then sell it. So this will be covered under Ind AS 2 because basically the property is an inventory for the real estate broker and it's not an investment property for them. Next is employee occupied property. So let's say you are a company and you let out the guest house to your employees or you have employee occupied quarters, then it will come under Ind AS 16 and not Ind AS 40. So the examiner might try to confuse you here by saying that it is let out at market rates similar to the rates at which it is let out to third parties. Still, it will come under Ind AS 16, guys. Very important. That's why I've highlighted in red. So the points where you might go wrong, which are negative in nature, I've highlighted it in red, and the important points I've just bolded it out there. So you can just use this color coding and proceed. Next, ROU let out under finance lease. So as I told you at the starting, your ROU let out under finance lease would not come under Ind AS 40 ambit, it would come under Ind AS 116 ambit. Next, your property constructed or developed for future use as investment property. So let's say you're constructing a property for future use as investment property, that will come under Ind AS 40 ambit and not under Ind AS 16 ambit. So it will be an investment property under construction in your financial statements and not a capital work in progress. I hope you understood this. Next, let's say you hold a property for more than one purpose, like that is it's partly for business and partly as investment property. Suppose you're able to split it. Let's say you have a building of 3 floors. Let's say one floor is held as an investment property, 2 floors are held as property plant equipment. For the 2 floors, you will apply Ind AS 16 accounting, and for the 1 floor, you will apply Ind AS 40 accounting. Next, let's say the entity is unable to split. Like let's say you have a 3-bedroom house. Let's say one bedroom with house, you're letting it out to a third party, and 2 bedrooms you're self-occupying. In such a scenario, so if you see your owner occupied portion is significant, so you will treat the entire property as a property under Ind AS 16 and not split it as 2 bedrooms as Ind AS 16, one as Ind AS 40. Okay, let's take another scenario. So let's say you occupy 1 bedroom and you let out 2 bedrooms. In this scenario, some of you might get confused and say that, sir, your self-occupied portion is not significant and your let out portion is significant, so it will be Ind AS 40. No guys, significant doesn't mean like 70%, 80%, 90%. It can be anything greater than or equal to 35%. So that's what I've given a note here. Like let's say you occupy only 1 bedroom out of the 3 bedrooms, still it will be considered as significant and you will apply your Ind AS 16 accounting and not in Ind AS 40 accounting. So unless and otherwise it is given as not so if the question clearly says it is not significant, then you can take the Ind AS 40 call, or else you will have to assume that it is significant and write the answer as Ind AS 16. I hope you understood this, guys. Next term. Your classification as investment property or PP based on nature of services given. If the nature of services are insignificant, let's say you have a guest house and you provide only security services in that guest house. In such a scenario, the guest house will be classified as an investment property in the books of accounts. If the services given are significant, let's say ITC has a chain of hotels. Let's say ITC in their hotels provide a variety of services. In such a scenario, the ITC will classify the hotel as property, plant and equipment under Ind AS 16 in its books of accounts and not investment property. I hope you understood this. Then property given on lease by a parent to subsidiary or by a subsidiary to parent. So in the separate financial statements of the lessor, that is the entity which is giving it out on lease, it will classify it as investment property. But in a consolidated financial statements, it will be classified as property, plant and equipment. Logic, because the property is owner occupied from the group's perspective. Because at the end of the day, either the parent is occupying it as an owner, or the subsidiary is occupying it as an owner. So for sure it is owner occupied from the standpoint of one of the entities in the group. So in your consolidated financial statements, it will be classified as property, plant equipment under Ind AS 16. I hope you understood this. Next, your transfers to or fro investment property classification. So all your transfers should be done at carrying amount. So some of the examples of your transfers are like basically your owner occupation is commencing. So in such a scenario, you will reclassify it from Ind AS 40 to Ind AS 16. So then you want to develop it further for sale. You intend to hold it as an inventory. Then you reclassify from Ind AS 40 to Ind AS 2. Then you're initially owner occupying it. Then you want to hold it as an investment property. Then it will be reclassed from Ind AS 16 to Ind AS 40. Then your operating lease commences. Then it will be reclassified from Ind AS 2 to Ind AS 40. Like let's say you were initially a real estate broker, then you understood that you don't want to hold this as a real estate property, you want to let it on operating lease. Then in such a scenario, you will reclassify from Ind AS 2 to Ind AS 40. Here the point D. And so this is again a very important point which I'm going to say now. It is neither a change in accounting policy nor prior period error. It is only a change in use of the property. So the question might ask you that, is this a change in accounting policy or a prior period error? Does the entity need to restate the financial statements? No guys, no restatement, nothing of the sort is required. And you have to ensure that the change is useful. Change is actually actual. Like for example, the management says that they will occupy the existing investment property in the future. It won't be PP at the time. It will become a PP only when the actual self-occupation happens. So you can't just say in thin air that I'm going to do this, so I'm going to reclassify. No guys, reclassification will happen only when the actual use has changed. So that's why I've given this example here for your remembrance. So when an entity decides to dispose of an investment property without developing it, the property is accounted for as an investment property until it's derecognized, meaning it's removed from the balance sheet. It's not reclassified as inventory. So guys, so basically what they're trying to say is, let's say you acquired an investment property, you acquired it as an investment property. Let's say you want to dispose it. Like let's say you feel that it's not of use anymore. Like let's say you were letting out for rentals to others. Let's say the area is not really popular now. There are other areas in the city that are developing better than this area, so you're not able to get a good rental for it. So you decide to dispose it off. In such a scenario, you will not reclassify it as inventory. It will still be investment property until it is disposed of. I hope you understood this, guys. Next, your fair value disclosure of investment property in the note stock accounts. As I said earlier, you will give a fair value disclosure of note stock in the note stock accounts, even though you don't follow the revaluation model for recognition of investment property. So an entity is encouraged to measure fair value by using the work of an independent valuer, but there is no compulsion to do the same. So guys, you are just encouraged to use an independent valuer. But suppose you feel that in your finance team there is someone who is very competent, who actually has a good valuation knowledge, who can do the fair valuation, you can definitely tell him to do the same. There is no issue with that. So in few situations, fair value may not be reliably measurable. So these are few scenarios where you may not be able to reliably measure the fair value. For example, your market for comparable properties is inactive. Like for example, there are very few investment properties where there are rent transactions that are happening, or transaction price indicates that the seller was forced to sell. Like the seller is like actually disposing it off at a very, very less value than the guideline value because it ends up being a distress sale. So that is one scenario. Then your alternate reliable measurements for fair value are not available. For example, let's say you're not able to use a very well-known method like discounted cash flow approach for the valuation of property. In such a scenario, you may not be able to reliably measure the fair value. Next, if fair value is indeterminable due to cases. So if the investment property is under construction, you have to determine the fair value when it is reliably measurable or the construction is complete, whichever is earlier. Like let's say your fair value is reliably measurable first, then you will measure on the date on which it's reliably measurable. Let's say your construction is completed first, you will measure the fair value on the date on which construction is completed. So it's whichever is earlier, guys. And next, your other reasons. So let's say you're not able to determine the fair value due to some other reason, like you feel that the base of measurement is not reliable, then you have to disclose that the fair value is indeterminable and reasons for the same. And if possible, you have to say the range within the fair value, within which the fair value is expected to lie. Let's say you feel that the fair value of the property could be anywhere between 1 crore to 2 crore, but you're not able to estimate as to whether it will be 1 crore or 2 crore or 1 crore 50 lakhs or 1 crore 75 lakhs. You can say that the range is expected to be between 1 crore to 2 crore. So you have to also give a disclosure of the valuation techniques and key inputs used in the valuation. For example, if you're using discounted cash flow method, you have to say discounted cash flow method is the valuation method. Key inputs, you have to say discount rate is so and so percentage, growth rate is so and so percentage, your range of inputs used. So your discount rate is expected to be between the range of 10 to 11%, but we as an entity have taken 10.5%, and you have to say the ranges, and you have to say what value you as a management have actually elected to apply in arriving at the fair value. You can say that, and the disclosure relating to amount recognized in the profit and loss account for investment property. So particulars amounts. So first you have to say what is the rental income from the investment property, and this is again a disclosure which you give in your financial statements for investment property. You have to then deduct the expenses you have incurred to generate the rental income. Then you will get a number which is the net profit before depreciation from investment property, and your investment property is also subject to depreciation, which you will reduce, and you will arrive at the net profit. So basically, I have a revenue from the investment property, which is the rental income. I've incurred some operating expenses. I've also getting a depreciation charge, which I will reduce to arrive and say that boss, this is the net amount which I'm getting, which you will disclose in your financial statements. So guys, this is all the standard is. So there are a couple of questions which I want you to just go through in this standard. So you can see TYK question 4, which has like 3 events, which is a very good question, which has not been tested so far. And your TYK 5 question, which basically contains an investment property disclosure. It's a very good question. It came in our 24 exams as well. It's very, very important. And you can also see your example 5, which is unlimited question in page 5.91. It's a non-cash consideration question. It's a very good question. And as I said, guys, if you want this PDF, you can join my Telegram channel in the link below in the description, and you can get these notes there. And I'm also going to keep the Telegram channel open, guys, for your suggestions for the videos you want next, and you can also ask any questions you want in relation to financial reporting and audit in the Telegram channel below, and I will be more than happy to respond to them. So what are you waiting for? Join the channel and do subscribe to this channel and keep learning, keep growing, and I'll meet you later. Thank you.